non-current assets. And the first accounting standard on non-current assets that we're going to have a look at is PPE. I say 16, PPE. Let me talk you through PPE before I write anything down. Let me write something pretty scrappy down unless I see people in tears. So we're talking about property, plant and equipment. Property, plant and equipment is tangible, so you can physically touch it. Property, plant and equipment has been acquired for use within the business. This table is an asset of FTMS because we're not trying to sell it, we're using it in our business. If you go into a furniture shop, the table is not PPE, the table is inventory. So it's your business model that comes into play. So PPE is assets that you acquire for use within the business. They have to have a life of more than 1 year. Initial recognition, cost. You would initially recognize an asset, an item of PPE at cost, at all the costs you incur in order to bring that asset into use. So you would include delivery costs. Yeah? If you have to pay someone to deliver the asset to you, you capitalize that cost. What about training costs? What about training the staff to use the asset? Would you capitalize that or expense? Expense, yeah, you would expense. Legal fees, because if you buy a property, you have to draw up a contract, employ a lawyer, capitalize that. Having capitalized all the costs you incur in order to bring the asset, not abnormal costs, not mistakes, yeah, you wouldn't capitalize those. If you then spend money on the asset later, so if you spend money improving the asset, making it bigger, better, faster, stronger, what do you do with that expenditure? Improvement, repairs, yes, improvements are capitalized, repairs, expense. Maintenance and repairs are day-to-day costs. There can be a subjectivity about when a repair becomes an improvement, but yeah, in principle you understand, we capitalize improvements and we expense repairs. What else do I want to say? Depreciation. You must depreciate. You must have a policy of depreciating the asset. All PPE is depreciated except land. Yeah, land. Except land, because land has an infinite life. Yeah? The idea is that land will go on forever and ever and ever, so therefore it's not consumed, it's not used up, and therefore on that basis, yeah, you would not depreciate land. So when you write out one check, when you make one payment for land and buildings, a property, you have to distinguish between the land element and the building element, because the building element is going to be depreciated. The same is true of an aeroplane. Yeah, if you buy an aeroplane, the engines may have a life of 5 years, but the fuselage may have a life of 10 years. So you would have to take the cost of the aeroplane, split it, depreciate each by different lives. Well, that's perfectly normal. That's perfectly normal. You would do the same if it required an overhaul. Yeah? If every couple of years there needed to be an overhaul, then the cost of the overhaul would be depreciated over 2 years, and then the overhaul keeps on being capitalised because that gives you an improvement, it gives you a benefit for 2 years. You benefit from the overhaul for that period of time. What else do you know about PPE?
Revaluation.
Yeah, we've done impairment. Yeah, revaluation. Yeah, revaluation. So, PPE would not be normally impaired, so you'd have to have an indicator for impairment. Yeah, but revaluation. You have a choice of revaluation. So, if you want to keep your PPE at cost, respect, fine. It's perfectly legitimate to keep the PPE at cost. But if you choose to revalue, I think you're being relevant. If you choose to revalue, I think you're being predictive. If you choose to revalue, I think you're helping the user better understand. And if you revalue, no cherry picking. If you revalue one property, then you have to revalue all the property. Doesn't mean to say you have to revalue your motor cars or your tables or chairs because they're a different class. So once you revalue one asset, then you have to revalue all the assets in the same class and keep the valuations up to date. Where do you take your gains and losses? P&L or other? If you revalue property, do we take the gain or loss to P&L or other? Other, yeah, OCR. Yeah, you take it to OCR. Yeah, I think I'm going to jot quite a lot of that down, but I can go fairly quickly. Yeah, we seem to be okay. So PPE is tangible. It's a tangible asset. It's acquired for use within the business. Yeah, so it depends on your business model, and it's expected to have a life of more than 1 year. Initial recognition is going to be at cost. All the costs you incur in order to create the asset. So initial recognition is at cost. Capitalize improvements. Yeah. Expense repairs. So subsequent expenditure, we know what we are doing. Depreciation. We must charge depreciation. The one exception is land. We must charge depreciation. The one exception is land. If you switch between straight line and reducing balance, that is a change in an accounting estimate. Your policy is to depreciate. So if you switch between straight line and reducing balance, that represents a change in an accounting estimate. And we looked at keeping our PPE up to date with ISA 8 and changes in accounting estimates on a prospective basis on a previous lecture. So you must depreciate. Depreciation is a non-cash expense. The one exception is land. Yeah, and yeah, we can have complex assets. Yeah, so we can have complex assets, which means you depreciate the aeroplane and you depreciate the overhaul at different lives. So you may have one asset, a building, but the land is not depreciated. If you can identify a certain amount for the lifts or a certain amount, yeah, then those would be depreciated over their own lives. Revaluation. When we talk about revaluation, revaluation is an accounting policy. It is a choice. If you revalue, then I think you're being relevant. You're bringing information up to date. It's forward-looking. If you revalue, you have to revalue all the assets in the same class. Yeah? Doesn't mean to say you have to revalue all the cars if you revalue a property, but if you revalue a property, you should revalue all of your property. So you have to revalue all the assets in the same class. We have to keep the valuations up to date. We have to keep the valuations up to date. And I want to do a couple of silly, small numerical examples. So,
this update can be quite subjective, so is it a...
I agree. If inflation is low, then maybe keeping it up to date means you only revalue it every 2 or 3 years. If inflation is high, then perhaps it's more appropriate to do an annual revaluation. But the point is, your valuations need to be up to date. I agree, it is subjective. Just like the estimate of the useful life is subjective. Yeah, these things are. Right, let's have a look at a small example and let's make sure you're comfortable with the consequences of revaluation. Let's have an asset which cost, I don't know, cost 20. Let's have a life of 10 years. Let's have a year 1 fair value of 27 and a year 2 fair value of, I don't know, 32. Right, that's my story, and I'm going to run this as quickly as I am allowed to. If anybody wants to see debits and credits or further little details and explanations, you have to ask and I will oblige. But this is my story. Year 1, the asset cost 20. You would charge depreciation over 10 years, so the asset would therefore be in the books at 18. At the year end, you conduct the fair value, so the fair value is 27, which therefore gives you a gain of 9. Right. Time out for a sec. Which figure is on the balance sheet as the asset? Which number? 27. So that figure is on the balance sheet. That is your PPE. Which figure is in the P&L as your expense? 2. So in the P&L, that is your expense. Where does the 9 go? OCI. So in your other comprehensive income, yeah, you have got 9, and that will also go in your balance sheet and accumulate in your other components of equity. So really, very simple, yeah? Yeah, no money is changing hands apart from the initial cost of the asset. Year 2. Hello. What's the opening balance of the asset in year 2? 27. How much depreciation are you going to charge? Yes. The life of the asset hasn't changed. The asset is now a year old, so the remaining useful life of the asset is 9 years, so the amount of the depreciation is 3, so the carrying value is 24, but then you do a revaluation, and doing that revaluation, you come up with a fair value of 32, so your gain is 8. Once again, what's your P&L expense? 3. What's your P&L expense? 3. What's your balance sheet for PPE? 32. And OCI is 8. This will also accumulate in your other components of equity. You do a profit and loss account for 1 year. So you put the expense in 1 year. So in the first year, the depreciation was 2. In the second year, the depreciation was 3. Your other comprehensive income is also for 1 year. So last year, you put in 9, and this year, you're putting in 8. But your balance sheet, other components of equity, is cumulative. Your balance sheet, other components of equity, is cumulative. What's the balance on the reserve at the end of the second year? 17, I hear. 17, I like. 17, I respect. But could you give me another number? 17's okay. You know, 17's not wrong, but there is actually an alternative balance on your other components of equity. 16. Yes. 16. Oh my God. What's happening? Excess depreciation. Yes. Do you remember this story? Do you know this story? I'm about to tell you the story. There is the concept of excess depreciation. Because you have revalued the asset upwards, you're charging more depreciation. Because you're charging more depreciation on that revaluation, we're now charging depreciation 3, whereas previously we had charged depreciation of 2. So therefore there is an excess depreciation of 1. You have reduced your profit by 1, and sometimes people feel that's a bit harsh. So you still charge it, but what you do is a movement on the reserves. You do a movement on the reserves. You take 1 out of other, and you transfer it to the retained earnings to reflect the realization of the reserve, to reduce the reserve down. Because arguably, by the end of the asset's life, the asset will have disappeared, but also the reserve should disappear. There should be a regular little transfer. So this is known as excess depreciation. So the balance that I'm thinking about here, is 16. The balance that I'm thinking about here is 16. I'm going to write that down. Yeah, I'm going to write that down. I'll show you everything that's going on there. But before I write it down, does that vaguely make sense? Excess depreciation, writing it out of the reserve, putting it back into retained earnings. So